What you're watching right now feels like a contradiction that shouldn't exist. Energy infrastructure across multiple countries is burning, geopolitical tensions are escalating at a pace we haven't seen in years, and yet the very assets people expect to surge in chaos, gold and silver, just dropped hard. That disconnect is exactly why so many people are confused, and if you're trying to make sense of it, you're asking the right questions. Because on the surface, it doesn't add up. War expands, supply chains get hit, oil spikes, uncertainty explodes, and gold falls, silver drops. It feels backward. But what's happening here has very little to do with the long-term value of these metals and everything to do with how money moves during stress. There's a mechanism behind this, and once you understand it, the fear starts to lose its grip. When markets enter crisis mode, everything changes. Large institutions, hedge funds, banks, pension funds don't operate like individual investors. They hold massive portfolios made up of different assets, stocks, commodities, bonds, metals. In normal conditions, each asset behaves based on its own fundamentals. But in a crisis, those distinctions disappear. What takes over is liquidity. When volatility spikes, losses in one part of a portfolio can trigger margin calls. That means institutions are suddenly required to produce cash fast. Not tomorrow, not next week, but immediately. And they don't get to choose the perfect moment to sell. They have to raise liquidity on demand. So what do they sell? Not the assets already crashing. That would lock in heavy losses. Not the ones tied up or illiquid. They sell what can be converted into cash instantly, in large size, without friction. And that's where gold and silver come in. Gold, especially, is one of the most liquid assets in the world. It trades around the clock, across global markets in enormous volumes. If an institution needs to raise hundreds of millions in minutes, gold is one of the easiest ways to do it. Now imagine not just one fund doing this, but hundreds, all at once, all under pressure, all selling the same liquid assets into the same window of time. That's how you get a sharp drop in gold and silver, even while the world looks like it's falling apart. It's not about value changing, it's about forced selling. And forced selling has a very specific characteristic. It's temporary. Once those margin calls are met, once the liquidity pressure eases, that wave of selling runs out of fuel. And when it does, prices don't just drift, they often snap back toward where fundamentals suggest they should be. That's the part most people miss. They see the drop and assume something broke. But in reality, nothing fundamental changed. The same supply constraints, the same geopolitical risks, the same inflation pressures are still there. Now layer in what's actually happening globally. We're not talking about isolated tension. We're looking at coordinated strikes on critical energy infrastructure across multiple countries in a very short time frame. Facilities that play major roles in global oil and gas supply have been damaged, shut down, or disrupted. And when energy infrastructure is hit at that scale, it doesn't just affect one region, it ripples outward. Energy prices feed into everything: transportation, manufacturing, food production. When energy rises, costs rise across the board. That's inflationary pressure, and it doesn't disappear overnight. At the same time, geopolitical escalation reduces the likelihood of quick resolutions. When conflicts expand and more countries become involved, the timeline stretches. Markets may react in bursts, but the underlying tension lingers, so you end up with two forces happening simultaneously. On one side, you have short-term liquidity stress pushing prices down. On the other, you have long-term fundamentals becoming stronger. That tension is what creates these moments of confusion and opportunity. A lot of people are also drawing comparisons to past cycles, especially periods where gold surged and then crashed before recovering. And yes, visually, charts can look similar. A sharp rise followed by a sharp drop can trigger memories of previous downturns. But surface-level similarities don't always mean the underlying structure is the same. The scale of the move matters. The type of demand matters. The broader economic environment matters. In earlier cycles, massive percentage gains were often driven heavily by speculation. When that kind of momentum unwinds, the fall can be deep because it wasn't anchored by strong long-term demand. Today, the landscape is different. A significant portion of demand is coming from institutions and central banks. These aren't short-term traders chasing price action. They're making strategic decisions about reserves, currency exposure, and long-term stability. That kind of demand behaves differently during downturns. Instead of exiting, it often accumulates. At the same time, there are signs that the physical market, actual supply of metals, is under strain. When physical availability tightens while paper prices fall, it creates a divergence. And historically, those divergences don't last forever. They resolve. Another key difference is the interest rate environment. In past cycles, aggressive rate hikes created strong incentives to hold cash instead of non-yielding assets like gold. When safe returns are high, the appeal of holding metals weakens. But in the current environment, central banks face a difficult balance. Inflation pressures remain, but aggressive tightening risks pushing economies into deeper slowdowns. That limits how far rates can realistically go. And when real interest rates, after accounting for inflation, remain low or negative, the case for holding hard assets strengthens over time. All of this feeds into a bigger picture. Short term, markets are reacting to stress, liquidity needs, and rapid shifts in sentiment. Long term, the structural drivers, debt levels, currency dynamics, geopolitical instability, inflation, haven't gone away. If anything, they've intensified. That's why moments like this feel so disorienting. The screen shows one thing, but the underlying data tells a different story. And that gap between perception and reality is where the hardest decisions get made. It's easy to feel confident when prices are rising. It's much harder when everything turns red. But historically, the biggest opportunities don't show up when things feel comfortable. They show up when uncertainty is at its peak. That doesn't mean prices can't go lower. They can. Markets rarely move in straight lines, and volatility tends to cluster during periods like this. But understanding why something is happening changes how you respond to it. If you believe prices are falling because fundamentals collapsed, the logical reaction is to exit. If you understand that prices are falling subsabab liquidity pressure while fundamentals remain intact, the perspective shifts. You start watching different signals. You look at whether selling pressure is easing, and you watch how markets behave around key levels. You pay attention to whether demand, especially institutional demand, shows signs of stepping in. You also keep an eye on broader factors, energy prices, inflation data, currency strength, and geopolitical developments, because those are the forces that shape the next phase, not just the current one. There's also a psychological element that can't be ignored. Fear spreads quickly in markets. When prices drop sharply, narratives form just as fast. Comparisons to past crashes, predictions of deeper collapses, worst-case scenarios, they all gain traction because they align with what people are feeling in the moment. But markets don't reward emotion. They reward clarity. And clarity often comes from stepping back. Look at the bigger trend, not just the last few days. Look at where prices started, where they moved, and what drove those moves. Context matters. A sharp correction inside a broader upward trend looks very different from the beginning of a long-term decline. Right now, we're seeing a violent move, but within a larger structure that has been building over time. Whether that structure holds or breaks will depend on how these underlying forces evolve. That's why specific levels in the market matter. Not because they're magical numbers, but because they represent areas where behavior changes, where buyers step in, where sellers lose momentum, where trends either stabilize or accelerate. Watching how price reacts around those levels gives insight into what comes next. But beyond charts and numbers, the key takeaway is this. Not every drop is a signal that something is wrong. Sometimes it's a reflection of how the system operates under stress. Liquidity crises don't discriminate. They force selling across assets, even those that are fundamentally strong. And when that pressure passes, the market recalibrates. The challenge is sitting through that process without letting short-term noise override long-term understanding. Because in moments like this, the market isn't just testing price levels, it's testing conviction. And the difference between reacting emotionally and responding strategically often comes down to one thing: understanding what's actually happening beneath the surface. Right now, the surface looks chaotic, but underneath, the same forces that drove the rise are still in place. And eventually, the market has a way of reconciling those two realities.